Pop quiz time! What's a financial tool that allows you to tap into the equity of your home while you still live in it? You've got it! It's a reverse mortgage. Today, we're diving into the world of reverse mortgages. This intriguing financial tool can be a lifeline for homeowners, but it also comes with its own set of considerations. We'll be exploring what a reverse mortgage is, its potential benefits, and even its drawbacks. So stick around if you want to unravel the mystery of reverse mortgages. It's not as complicated as it sounds, promise. Welcome to Money Funnel, your ultimate gateway to financial empowerment. Get inspired, get motivated, and learn the path to true wealth so you can live the good life. Please help us grow this channel by subscribing now. Don't forget to hit that like and notification bell for more motivational and financial tip videos. Watch until the end for the simple and detailed summary of our discussion. Alright, so what exactly is this reverse mortgage thing? Let's dive right into it. Imagine you're sitting on a gold mine, but you can't dig up the gold. This is kind of what a reverse mortgage is like. You've got this valuable asset, your home, and a reverse mortgage allows you to tap into that value without having to sell the house or move out. Here's the deal though. Not everyone can just decide they want a reverse mortgage and get one. There are some boxes you'll need to tick first. You've got to be at least 62 years old, the home must be your primary residence, and you've got to own that home outright, or at least have a considerable amount of equity in it. Now let's talk about how it works. In a regular or forward mortgage, you make monthly payments to the bank to slowly chip away at the loan you took out to buy your house. A reverse mortgage, as the name suggests, flips this on its head. Instead of you paying the bank pays you. This can be in one lump sum, monthly payments, or a line of credit. But what about repayment? Well, the loan doesn't need to be repaid until the last surviving homeowner either sells the home, moves out, or passes away. At that point, the home is sold, and the proceeds go towards paying off the loan. If the sale of the home doesn't cover the full loan amount, don't worry, the lender can't come after your other assets or your heirs for the balance. That's a non-recourse clause for you. In essence, a reverse mortgage is a financial tool, giving homeowners the chance to turn the equity in their homes into cash, while still being able to live in and own their house. Majority of applicants get the most money from the Home Equity Conversion Mortgage, HECM, a federally insured program. Now that we've got the basics down, let's talk about why someone might consider a reverse mortgage. You might be wondering, why would anyone want a reverse mortgage? Well, there are actually quite a few benefits. First off, a reverse mortgage can be a great way to alleviate the financial stress of those golden retirement years. Unlike a traditional mortgage, a reverse mortgage doesn't require you to make monthly mortgage payments. Imagine your home paying you, instead of the other way around. This can be an absolute game changer for many retirees who are living on a fixed income. Now let's talk about the comfort of home. With a reverse mortgage, you retain ownership and can continue to live in your home. Picture this. You're enjoying your morning coffee in your cozy living room, knowing that this house, your house, will continue to be your sanctuary, your family gathering place, your home sweet home. You don't have to give up what's familiar and comforting to you, but the benefits don't stop there. Another big advantage is the flexibility of funds use. The money you receive from a reverse mortgage can be used for just about anything. Need to cover healthcare expenses? Check. Want to pay off existing debts? Check. Dreaming of that grand European tour? Check. You get to decide where your money goes. Let's look at a real-life example. Meet Mr. and Mrs. Smith, longtime homeowners who have seen their neighborhood transform from a quiet suburb to a bustling city. Their home's value has skyrocketed over the years. With a reverse mortgage, they were able to tap into this equity, ensuring a steady stream of income to support their lifestyle and medical expenses without having to sell their beloved home. Or consider Mr. Johnson, a widower with grown children. He took out a reverse mortgage to pay off his existing mortgage and used the remaining funds to travel and enjoy his retirement, all while remaining in the home filled with memories of his family. It sounds pretty good, right? But as with everything, there are two sides to every coin. Let's explore some potential drawbacks. First off, the upfront costs of a reverse mortgage can be quite high. We're talking about loan origination fees, mortgage insurance premiums, and closing costs. To put it in perspective, imagine you're buying a new car, and on top of the sticker price, you have to pay a hefty premium just for the privilege of driving it off the lot. That's what these upfront costs can feel like. Secondly, a reverse mortgage could potentially impact your eligibility for public benefits. If you're depending on Medicaid or supplemental security income, the funds from a reverse mortgage could be seen as assets. It's like finding a treasure chest only to realize that the gold coins inside might cost you your lifeline. Lastly, let's not forget that a reverse mortgage depletes your home equity, which is the portion of your home you truly own. It's like having a piece of cake and gradually seeing it shrink with each bite. With a reverse mortgage, each cash advance you take is a bite out of your home equity. When the cake is gone, it's gone. These drawbacks don't mean that reverse mortgages are bad per se, but they do highlight the need for careful consideration. So it's clear that reverse mortgages are not a one-size-fits-all solution. They have their pros and cons. So to summarize, a reverse mortgage is a unique form of home loan offering 3 key features. 1. You are not required to repay the loan as long as you reside in your home. 2. The funds can be dispersed to you in various ways, including a lump sum, regular monthly income, or customized payments based on your preferences. 3. Repayment of the loan, along with accrued interest, only becomes due upon the sale of your home, when you move away permanently, or in the event of your passing. This financial arrangement provides flexibility and allows homeowners to access the equity in their homes without immediate repayment obligations, contributing to a more adaptable and personalized approach to managing home finances. 2 things to keep in mind. 1. As you are not making monthly payments, the owed amount accumulates gradually. It's important to note that, as mandated by law, the total owed can never exceed the appraised value of your home at the time the loan is settled. 2. While retaining ownership of your home, you are responsible for covering property taxes, insurance, and maintenance expenses. Failure to fulfill these obligations may empower the lender to utilize the loan for these payments or request full repayment from you. It's crucial to stay current on these financial responsibilities to maintain the terms of the arrangement. Who are eligible? All homeowners must be at least 62 years old. The home must be your primary residence, and you've got to own that home outright, or at least have a considerable amount of equity in it. What are the eligible homes? Eligible properties are single-family, 1-unit dwelling, 2 to 4-unit owner-occupied dwelling, some condominiums, planned unit developments, or manufactured homes. Note that cooperatives and most mobile homes are not eligible. How much will you get with the reverse mortgage? The sum you receive generally hinges on factors such as your age, the value and location of your home, and the expenses associated with the loan. Typically, the highest amounts are allocated to elderly homeowners residing in pricier homes, opting for loans with minimal costs. The majority of individuals secure the greatest funds through the Home Equity Conversion Mortgage, HECM, a program under federal insurance. How do you get paid? You can elect to get paid all at once in cash, as a monthly income, as a credit line that lets you decide how much you want and when, or in any combination of the above. What are the 2 types of reverse mortgages? Loans provided by certain states and local governments are typically designated for specific objectives like covering home repairs or property taxes, making them the most economical reverse mortgages available. On the other hand, loans from certain banks and mortgage companies offer a broader scope, allowing usage for various purposes. What are the costs for reverse mortgages? The costs consist of the application fee, insurance, origination fee, monthly service fee, closing costs, and interest. These expenses are typically incorporated into the loan balance, which adds to your overall owed amount. HECM loans consistently stand out as the most cost-effective reverse mortgage option available through banks or mortgage companies, often proving notably cheaper than alternative reverse mortgages. In the initial years of the loan, reverse mortgages tend to incur higher costs, gradually becoming more budget-friendly over time. Prior to opting for a reverse mortgage outside of a government or HECM loan, it's crucial to meticulously assess the potential additional expenses you may incur. So there you have it. We've demystified the concept of reverse mortgages. We highly encourage you to consult with a financial advisor before making any decisions. This complex financial product requires careful consideration. Remember, knowledge is power, so go out there and make the best decision for your financial future. Until next time. To learn more motivational and financial tips, watch the next video recommended by YouTube here.